if you want to forecast, it's going to get there much faster than people realize. Saying $10,000 gold, yeah, it'll get there, of course. Could very well happen in 2026. And again, consistent with our, let's say you own 50 ounces of gold and gold goes up $1,000 an ounce. You just made $50,000. That's true. Goes up another $1,000 an ounce. Hey, you just made another $50,000. Nice going. But the point is you get anchored on the $1,000 increment. But each increment is easier than the one before because you're working off a larger base. So when you go from $3,000 to $4,000, that's a 33% increase. That's a heavy lift. 4 to 5, 25%. That's another heavy lift. But 9 to 10 is 11%. That's like a good month. In other words, you're going to chug your way to $5,000 a little bit higher, but you're going to go 7, 8, 9 really fast.
Volatility has picked up a bit, but all this volatility is taking place above the old double top. So I think silver is now broken out, and I think that's very good for the gold bull market. I think if silver continues to outperform gold, gold's going higher. Just silver is going to go higher more. And I do think that there are a lot of shorts in the silver market, and they could be in a lot of trouble if this price keeps moving. I mean, I would not be surprised to see $100 silver next year.
Gold and silver are entering a phase where the old assumptions may no longer apply. The move is not just about inflation or short-term market volatility. It is about confidence in paper money, central bank accumulation, and return of hard assets as real monetary protection. Peter Schiff, a long-time advocate of sound money, and Jim Rickards, a macro strategist known for his work on currency systems and gold, explain why this metal cycle could accelerate much faster than most investors expect. Rickards argues that $10,000 gold is no longer an extreme target and could potentially arrive very quickly even in 2026. His point is that as gold rises from higher levels, each new $1,000 move becomes easier in percentage terms. Schiff adds that silver's breakout is now confirming the gold bull market, with silver trading above its old highs and shorts, potentially under pressure. He says $100 silver next year would not surprise him. Now, we present the clips from their interview. Before we discuss this, please hit the like button, subscribe to the channel and ring the bell icon. Thank you and enjoy the video.
Well, I think gold has a long future, bright future. And I think gold is going to kind of resume the monetary role that it played for most of human history or, civilization. We've kind of moved away from gold as money over the last 50 or some odd years. And we've experimented with fiat currencies as an alternative to real money. And I would say that it's a failed experiment. And I think it's coming to an end. And I think that's the reason that we're seeing the rise that we've seen in the price of gold recently. Gold prices have doubled, more than doubled in the last couple of years. And central banks, foreign central banks have really started to accumulate gold again. They now have more gold than U.S. treasuries, and that is going to continue that trend. And I think central banks are doing this for a reason. I think at this point, they know that the dollar's days as the reserve currency are nearing an end. How many days left is anybody's guess. But I think they are preparing for a world where they need to back their currency with real money. And that's gold. And I think what's interesting about gold's future, and I just came from this blockchain week in Dubai, and the people in the Bitcoin community just believe that gold doesn't have a future because Bitcoin is the future of gold, as digital gold, as something that's better than gold. And I think what that community doesn't really understand, and there's a number of things they don't understand, but I think what blockchain does, it doesn't replace gold. It actually improves gold. It actually makes gold more useful as money than it was in the past, because instead of being limited, to physical proximity, where if I have gold and I want to transact with it, not just use it as a store of value, but if I want to use it as money, as a medium of exchange, I need to be physically located with the person who I'm paying. You can have gold ownership represented by paper, which is what we did for a long time, under a gold standard. You didn't always bring your gold around. You had a note that was effectively an IOU, the gold was in a vault somewhere, either at a blacksmith or at a bank. And rather than paying the gold, you would pay a note that was an obligation for the issuer to pay gold. And so that was currency. But now with blockchain, you can take that to a much higher level, because I can now tokenize gold. And now, instead of writing a piece of paper that represents ownership of gold, you can have a token. And that token is easily transferable and divisible in a way that makes gold even better as a medium of exchange than it's ever been. Right? People, the Bitcoin community wants to criticize gold and say, well, it's not as divisible as Bitcoin, or as portable, or as fungible. Yes, as a physical metal, but once you tokenize it, it does everything that Bitcoin does, except it does it better, faster, and cheaper. And unlike Bitcoin, it actually has value. It actually has, a tokenized gold would actually be digital gold, because its value would be derived from the gold that backs up the token. The token would be redeemable in actual gold. So in that sense, it would be digital gold. Bitcoin is a digital fiction, it's fool's gold. So I think that blockchain and what is happening right now with technology, I think is going to help bring the gold standard into the 21st century, as will the currency crisis, the dollar crisis that I think we're headed for. Mm-hmm. And I think the only way out of that crisis is to return to real money, and that's gold.
And they are also a buy and hold investor, because that's the structure of any stable coin or tokenized gold. You're not trading the gold. You
right, but their liabilities aren't in gold. Their liabilities are in dollars, yet they're taking the dollars that they're getting and they're using them to buy gold.
Right.
So that,
but you're right, Peter. But my point is that's very bullish for gold, because they're not sellers.
Well, they're not. But the question is, why are they doing it? I mean, in my mind, to me, it might be that they need to make up the shortfall that they have in dollars by owning gold. Because if gold appreciates more than the dollar, then that's going to bail them out. If they don't really have enough dollars to back up their tether, they'll get more dollars by buying gold.
Right. But simply making their own central bank.
But they all also, though, they are doing a gold stable coin, which means there could be more demand for that gold stable coin.
Right, but look at the world. So central banks are buyers, but they're not sellers. Stable coins, Tether Gold are buyers, they're not sellers, et cetera. We now have a set of people who are just buying the gold it's sitting on. They're not, hedge funds will trade it. They don't care if it's soybeans or gold or whatever. But we now have a very large set of buyers who are just sitting on the gold. Mining output is flat. It's about 4,000 metric tons a year. I'm not talking about peak gold or whatever. Although I invest in gold mines, it is getting harder to find high-grade deposits. But that aside, it's been flat. So when you have increasing demand and flat supply, at least where I went to school, that means a higher price. A $10,000 an ounce gold is kind of commonplace at this point. I've been saying for a while, but now, you can't, look on YouTube or go on the internet without finding somebody talking about $10,000 gold. But here's my point, and call it value added if you want to forecast. It's going to get there much faster than people realize. Saying $10,000 gold, it'll get there, of course, but how quickly? It'll happen very quickly. Could very well happen in 2026. And again, consistent with our fifth grade math, approach. The reason for that is partly a simple math and behavioral psychology. In behavioral psychology, there's a whole set of biases. There's 100 plus biases, but one of them is called anchoring. And anchoring is we get an idea or a number in our heads, and we treat it as an anchor, and we filter all the incoming data through that anchor. And so, for example, let's say you own 50 ounces of gold, and gold goes up $1,000 an ounce. You just made $50,000. That's true. Goes up another $1,000 an ounce. Hey, you just made another $50,000. Nice going. But the point is, you get anchored on the $1,000 increment. But each increment is easier than the one before because you're working off a larger base. So when you go from $3,000 to $4,000, that's a 33% increase. That's a heavy lift. 4 to 5, 25%. That's another heavy lift. But 9 to 10 is 11%. That's like a good month. In other words, you're going to chug your way to $5,000 a little bit higher, but you're going to go 7, 8, 9 really fast.
Whether you agree with me or Jim on some of the other issues, it doesn't matter which one of us you agree with when it comes to gold and silver, because we're both saying that, well, gold and silver prices are going up. So it doesn't matter which one of us is right or wrong from that perspective. And the fact that you mentioned silver, and to me, what's happening with silver is very bullish for gold, because there were really like two knocks against the gold bull market. One was that silver wasn't participating, and the other was that the miners weren't participating. And people would look at gold's rally and say, look, it's not being confirmed by the mining stocks. It's not being confirmed by silver. And so, maybe it's just gold's going to come back down, right? It's not what the markets are telling you. What the gold stock market is telling you is that the gold rally isn't real, because investors are not willing to pay up for gold stocks because they know that the price won't be this high in the future. It's just high now and it's going to come down. And silver wasn't confirming gold. But now this year was a great breakout year for the miners. Mining stocks are outperforming gold. Gold's up 60%. Mining stocks have more than doubled. Some have tripled. Some have quadrupled. They're not expensive because they're catching up with decades of not doing anything. But now gold stocks are kind of leading the metal, and gold stocks will make a new high probably before gold does. But also silver is now leading gold. Silver is up over 90% this year. And silver broke out finally of its 1980 Hunt Brothers high of $50. It got back up to it in 2011 when gold got to 1900. But when gold finally got back up to 2000, forget about it, briefly got up there during COVID, but then sold off. But when it broke through 2000 really for good in early 2024, silver was still below $30. Wasn't even close. And silver finally got up to 50, and now it's gotten as high as 59 and change. And it's been trading now around 57, 58. Volatility has picked up a bit, but all this volatility is taking place above the old double top. So I think silver is now broken out, and I think that's very good for the gold bull market. I think if silver continues to outperform gold, gold's going higher. Just silver is going to go higher more. And I do think that there are a lot of shorts in the silver market, and they could be in a lot of trouble if this price keeps moving. I mean, I would not be surprised to see $100 silver next year. And, I don't know where the shorts stand right now, where it is. But I would imagine they're trying to keep the price down. But to me, it looks like a lot of silver's going up. And I think one of the things that drove gold was the central banks were not buying silver. They were only buying gold. But the fact that you're starting to see silver move, it's not the central banks that are buying it. These are private investors that are buying silver. And so they're finally coming into the market. The central banks don't have the precious metals markets to themselves anymore.
The deeper message here is that gold is no longer moving alone. For years, skeptics argued that the gold rally was not real because silver and mining stocks were not confirming it. That argument is now weakening. Mining shares have started outperforming gold, and silver has finally broken through levels that capped the market for decades. This matters because silver often acts like a high beta version of gold. When silver begins to lead, it can signal broader investor participation in precious metals trade. Peterschiff believes private investors are now entering silver while central banks continue focusing heavily on gold. At the same time, Jim Rickards points to a powerful supply-demand imbalance. Central banks, stablecoin issuers, and long-term holders are buying gold and not selling, while mining output remains relatively flat. That combination creates a strong foundation for higher prices. Now, let's get back to the interview.
Well, I wouldn't say there's no risk to the dollar. I do think the so-called debasement trade that, central banks are dumping U.S. Treasury securities, and the days of the U.S. dollar as the global reserve currency are numbered. And there's going to be a rejection of that and a flight to gold as the new money, the new monetary standard. I do think that's largely incorrect. Now, central banks are buying gold. That's just a fact. And Peter mentioned that, and he's right. They're increasing their gold reserves. It's a big deal. That inflection point took place in 2010. From 1970, if you want to start there, to 2010, central banks were net sellers the entire time. Beginning in 2010, they became net buyers, and that buying has been going up. Now, that's not the same central banks. In the 70s and 80s, you had the U.S. The U.S. sold 1,000 tons of gold between 1970 and 1980, even after, when you 71 as a point of reference, even after Nixon ended the convertibility of Treasury securities into gold, the U.S. continued selling gold throughout the 1970s, along with the IMF, as a kind of price suppression mechanism because they didn't want gold to go up too much. But then we stopped cold in 1980. The U.S. has not sold any gold since 1980.
That we know of.
Well,
or they may have leased it out. Who the hell? Maybe they didn't sell it. But
leasing is a separate issue. We can talk about leasing, but they haven't sold any. I think there may be. You have to dig pretty deep, but I think there's a reason for that. And it's very significant for gold investors. And leave aside whether we return to a gold standard or not, that's a big deal. But if you're just an investor in gold and you're concerned about the price, it's kind of nice to know that the country that has 1,833 metric tons cannot be a seller. And this goes all the way back to 1934 when FDR not only confiscated gold from individual U.S. citizens, which he did, although there's a little more nuance to that, but basically took over the Federal Reserve's gold because gold kind of went from individual hands to banks. And then in World War I, it was all melted down into these 400-ounce bars. Well, you're not going to be walking around with a 400-ounce bar in your pocket. So the banks kind of came in possession of the gold, issued paper currency, banknotes, et cetera, for that. But then coming forward to 1934, then the Federal Reserve took it from the banks. They said, hey, if you want to be a member bank, give it to the Federal Reserve. I said, okay. And then Roosevelt, FDR, took it from the Federal Reserve and gave it to the Treasury. However, the Federal Reserve, as we know, is privately owned. And the Fifth Amendment to the U.S. Constitution says the government cannot take private property for public use without giving fair compensation. That's the Constitution. So the question is, what was the compensation that the Treasury gave to the Fed when they took all of the Fed's gold? And the answer is they gave them a piece of paper called the gold certificate. And if you go to the Federal Reserve balance sheet, which is a public document, you got to dig around the website a little bit, but if you look at the Fed's balance sheet, and it's right there, the first item on the asset side is gold certificate, and they get billions or trillions of dollars of Treasury securities and a lot else, and all the liabilities or excess reserves, et cetera. But that gold certificate is still there. But if you take the value of the gold certificate, and the Fed keeps it at historic cost, which for them was, well, they upgraded it once, but it's the $42 price that we talked about that came out of the Smithsonian Accord. If you divide the value on the balance sheet by $42 and convert that into metric tons, you come out almost exactly to 8,133 tons. It suggests to me, and I want to be clear, this is a hypothesis, I can't prove this, but it suggests to me that the Treasury cannot sell any more gold because to do so would violate the covenant of this gold certificate the Fed got under the Fifth Amendment. The significance of that, and it's interesting, kind of down in the weeds legally, but what's interesting about that is if the biggest holder is not a seller, and all the other central banks combined, including the U.S., are net buyers, then you've got a really nice floor under gold. It's not a guarantee. It's maybe a little bit of a soft floor, but what the United States did do after that, we got everyone else to do our dirty work. So in the 1990s, we got the British to sell half their gold.
Brown's bottom
at $250 an ounce. You used to see Gordon Brown around, in Soho at the Red Four, which is a very popular Indian restaurant. But $250 an ounce. Nice going, Gordon. But then after that, we got the Swiss to sell. And the Swiss sold 1,000 tons in the early 2000s to the point that the Swiss were up in arms. They had a referendum. The referendum failed, but the referendum to stop selling gold. The referendum failed, but the government got the message.
Well, they had a more recent referendum to require the government to buy gold.
Right.
And they spent a lot of money, the government did, campaigning against that.
Yeah.
Because otherwise it might have passed. Because meanwhile, what is this Swiss central bank buying? They're just buying, stock, U.S. companies.
That's right.
And they were saying, look, we want the central bank to put some of that money into gold.
Yeah.
And in fact, they own a lot of U.S. tech stocks, so I guess they've on paper done well, but they would have done a lot better, I think, had they bought some gold.
Right.
Because obviously, when that referendum was circulated, gold was under $2,000.
Yeah. So there's among the Swiss citizens, there was a lot of opposition to selling any more gold. You're right. I think it would be good. I think it would be a good idea if the U.S. Treasury started buying gold. That's a separate issue. But my point is, the Swiss did sell 1,000 tons, and then they stopped.
Yeah.
Then the last big sale was the IMF sold 450 tons in 2000. What I say is accurately portrayed online. About 90% is other. No, seriously, you lose control over your own name. It's unfortunate, but the people who like do their own YouTubes, they'll rip something I did 2 years ago and stick it on a YouTube with some dynamic headline. Jim Rickards says this. I never said it. So. I mean, I know a lot about the LBMA. I know a lot about the COMEX. I'm one of the geeks who's actually read the rule books. One thing I know, every exchange rule book I've read has a rule that says they can change the rules. It's in there. It says in the event of disruptive markets, et cetera, the futures exchanges over and over again. And again, it's in the rule book, but they say we are not a source of supply. If you're in the futures market and you're long, and they only allow a certain amount of physical delivery just to keep everybody honest, to kind of keep the physical and the derivatives market in line. But if people go into the futures market expecting it as a source of supply, they'll say no. They will close the market, or more likely they'll give an order, what's called trade for liquidation only. I mean, if you're long, you can short. If you're short, you can go long. You can pair off, but you can't get the gold. Blythe Masters, who for many years was the head of global commodities trading for JP Morgan, she kind of moved on to crypto. I'm not exactly sure what she's doing these days, but she said something once. It was only 3 words, and I found it and I verified it, but you can't find it now. Somehow I got erased from the internet, but I did find it. She said, "Gold never settles." And what she meant by that, and she's right, what she meant by that is if all the paper gold, the futures, the options, the unallocated forwards, all the derivatives, all the paper gold in the world, if one side, if the long side that ever said, "Please give me the gold," it's not even close to being able to settle. It's 100 to 1 would be a conservative estimate. 500 to 1 is not out of the realm of possibility. There's a tiny bit of gold supporting all that paper gold. Everyone thinks they own gold. They don't. I explain it to them. No one listens, or some people do, but basically. And she said, gold never settles. But what she meant, just to expand on that, is gold can never settle because there's not enough gold.
What makes this decision important is the monetary shift behind the price action. Peter Schiff argues that the fiat currency experiment is failing and that gold is slowly returning to its role as real money for most of human history. In his view, the dollar's position as dominant reserve currency is nearing its end, and foreign central banks are preparing for a world where currencies may need stronger backing. Jim Rickards adds another layer by explaining why central bank gold buying is such a powerful signal. Since 2010, central banks have moved from being net seller to net buyers, and that trend has continued. He also suggests that the United States, as the larger gold holders, may not be a real seller, thereby creating a floor under the market. Schiff also challenges the idea that Bitcoin replaces gold. He argues that blockchain may actually improve gold by making tokenized gold easier to transfer, divide, and use as money. In that view, technology does not destroy gold's future. It brings gold into the modern financial system. Share your thoughts about this debate in the comment section below. If you like this video helpful, please hit the like button, subscribe to the channel and ring the bell icon. Thanks for watching.